So now we are ready to hear the other side of that pitch, which is initiating a new position in Qualcomm. And our presenter will be Brianna Short, who's a senior at Washburn, majoring in accounting and finance. Bree is completing the APM class in conjunction with her honors thesis, which is why she's solo authoring her report and presenting alone. Bree is the president of our Beta Alpha Psi chapter. She sits on the Dean's Advisory Council, and she's also a member of Beta Gamma Sigma and Phi Kappa Phi. Bree's future plans include preparing for and passing the CPA exam, note that, confidence, and then beginning to study for the CFA exam shortly thereafter because, you know, the CPA is just not enough of an accomplishment for some people. Bree already has several job offers, but continues her search for a financial analyst position. Here's Bree's quote about APM. "I have truly enjoyed challenging myself to synthesize large amounts of qualitative and quantitative information into clear and coherent investment theses for the stocks I've researched this semester." So it is my pleasure to introduce our next presenter, Bree Short, and her long recommendation for Qualcomm.
Hello everyone. As Dr. Wiegand just mentioned, I am Bree Short, and I will be giving you a presentation today over Qualcomm. Qualcomm is in the communications equipment industry. They design, develop, manufacture digital telecommunication products and services. Essentially, Qualcomm is a chip maker or a processor maker. They are headquartered in San Diego, California, with major locations in China, South Korea, Taiwan, and the US. Additionally, they have over 157 worldwide locations. Qualcomm is very globalized. Moving on to some of their key products, first we'll start with CDMA. CDMA is essentially a processor used in almost every single smartphone, including the iPhone 5, Samsung Galaxy, and HTC Evo. CDMA stands for Code Divisional Multiplication Access. And essentially what CDMA allows is that awesome processing you get from watching a movie on your iPhone or playing a game on your iPad. Just that voice processing and graphics processing is what CDMA will provide. Additionally, one of their key products is OFDMA. And this allows the phone or the tablet to reach the wireless networks, specifically 3G and 4G. And what's even more important to note about CDMA and OFDMA is the fact that Qualcomm patented both of these early in, well, CDMA was patented in 1989 with OFDMA patented in the 1990s. And they have renewed these patents in the last 2 years and therefore still hold on to these patents. But more importantly, the Snapdragon processor is the newest processor they currently have and has been thriving in the industry. Looking at the Snapdragon Processor 600, as I mentioned, it has been very successful. Shipments have increased by a 70% rate over the last year. Additionally, Samsung, HTC, and LG have all increased their adoption as well. It currently has a presence in the Apple iPhone 5, Samsung Galaxy, and HTC Evo. Also, just in the last week, I believe, the CEO of Qualcomm made a press release that the demand for the Snapdragon processor has actually just outstripped supply, and they are currently looking for new manufacturers to meet up or to keep up with this increasing demand. Overall, we attribute the Snapdragon processor and its extreme amount of growth in the industry and for consumer demand to why Qualcomm is stealing market share from Intel. Here's just a breakdown of Qualcomm versus Intel. As you can see, Qualcomm outperforms Intel in the majority of the metrics I have provided. Although Intel has a larger sales volume compared to Qualcomm, Qualcomm does maintain a higher revenue per share, a greater operating margin, and an extremely higher ROIC, which is very superior. On the other hand, Qualcomm does lag in the dividend yield, and that's why we are only trimming the exposure to Intel to keep that dividend yield while capitalizing on Qualcomm's growth potential. Moving on, here's just another slide detailing the mobile chip shipments, over the past 5 years. As you can see, from 2009 to 2012, it has grown year over year. And for 2013, it is expected to increase again from 2012. Moving on to an analysis of the second quarter actual results versus their budgeted. First, I want to draw your attention to their revenues. They are consistently hitting their revenues at the top of their budgets, and this just details that for the second quarter. Just a side note, they do have a year end of September 30th. Moving on, you can also see that their chip shipments have also reached the top end of their budgets, and this has been consistent throughout the past 3 quarters. Here I just give you a breakdown of their revenues by their operating or their business operating segments. Obviously, their Qualcomm CDMA technology segment represents the largest share of their revenues at 63.5%. And then revenues by country, I have 2 graphs here, one from 2010 and one from 2012. From 2010 to 2012, Qualcomm has grown its revenues $9 billion. And as you can see, China has accounted for almost half of that growth, and we are still expecting that growth to continue into the future. Moving on to the SWOT analysis. Some of Qualcomm's strengths include their superior patent protection, as I had mentioned, with their CDMA and OFDMA technologies. Furthermore, they are financially sound. They are essentially debt-free or have been debt-free for 3 of the last 5 years and have superior free cash flow abilities. Furthermore, their R&D continues to position Qualcomm at the leading edge of the industry. And again, their strategic alliances with Samsung and HTC and LG are also very beneficial to them and serve as a huge strength to their business model. Moving on to some of their weaknesses, first is their dependence on the third-party manufacturers. Additionally, poor overseas sales channels can lead to higher transportation costs, shrinking some of their margins. And then furthermore, there is a significant revenue concentration noted in their annual 10K. About 37% of their total revenues are concentrated in one customer located in Korea, and that would most likely be Samsung, although they are not required to put that into their 10K, which is obviously a weakness, just given the revenue concentration. Some of their opportunities include, first of all, the emerging markets, particularly China. China's growth is going to serve as a huge opportunity to Qualcomm, in addition to the growing consumer demand for being connected. In today's day and age, smartphones are moving more towards a consumer staple rather than a consumer discretionary, and this will serve to benefit and provide huge opportunities for Qualcomm. Furthermore, they will continue to leverage their R&D to continually position themselves at the top of their industry. Threats include, first, rapid technological changes. In the last 10 years, technology has changed drastically, and this could happen again in the next 10 years, which is an obvious threat. Furthermore, given their internationalization throughout the world, there is obviously the threat of instability amongst their countries, China, Korea, and then additionally, poor financial health of their major customers. Moving on to Porter's 5 forces, I'll start with supplier power. Supplier power was ranked low. Although some equipment has few suppliers and the underlying nature of their product, which is a chip, is somewhat undifferentiated, there is absolutely, well, not absolutely, but the majority of their suppliers have no threat of forward or backward integration. Furthermore, their buyer power is ranked as moderate. There was a significant consolidation in the telecommunications services industry with Verizon, AT&T, and T-Mobile, and that increases their buyer power. Furthermore, product differentiation, or the lack of, will provide low switching costs. And then additionally, their buyers right now, such as Verizon, Samsung, and those companies are not attempting backward integration and are not expected to in the future. Moving on to competitive rivalry, we rank this as high. This industry is highly competitive due to the low pricing power. They all essentially offer the same product with slight variations in the globalization of production. Despite such a highly competitive industry, Qualcomm has maintained at the top of the industry with a large ROIC. In highly competitive industries, we expect the ROIC to be smushed down. However, Qualcomm has maintained an ROIC of approximately 76%. Despite that, though, the competitive rivalry within the market is very high. Threat of substitutes was ranked as moderate. There is a dominant communications industry. Additionally, new innovations could occur at any time, just given the technological nature of the industry. Furthermore, buyers could create their own software, and substitutes are shrinking. And what I mean by the fact that substitutes are shrinking is that typically today, the GPS, the separate radio, we're not finding those anymore. We're finding all the GPS and radio into one product, the smartphone, or possibly the tablet. And that's what I'm meaning by the substitute shrinking. Moving on to the threat of new entrants, we rank this as low, just given the significant R&D and knowledge that is required to operate in this industry, the need for economies of scale, and then the capital intensity of the industry. In completing my analysis, I also like to look at some of what other analysts thought, such as Argus, Credit Suisse, and S&P, and Capital IQ, of course. So according to Argus, Qualcomm is a semiconductor leader in innovation, and they provided this really nice chart where it shows that Qualcomm is leading in the 5-year growth rate, but with a moderate PE ratio. Additionally, another interesting slide, or another interesting piece of research I found, was that Qualcomm is one of 6 stocks that meet the Buffett test, which is primarily designed off of the ability to generate strong free cash flows and a strong net profit margin. Moving on to the historical performance. Here's just a graph of their 3-year CAGRs. As you know, free cash flow has a 3-year CAGR of 1%, despite a 3-year CAGR of 20.5% for NOPAT. This indicates that the 3-year CAGR of total invested capital has shrunken that free cash flow 3-year CAGR. Additionally, it's important to note that total revenue has grown 22.6%, earnings per share has grown 55.2%, and dividends per share 12.1%. Moving on to margins and yields, Qualcomm has maintained a superior position in generating margins and yields, specifically margins. As you can see, their operating margin has remained relatively unchanged over the last 5 years, with a margin of 30.1% for the most recent year. The industry average for the operating margin is about 22%. Additionally, their free cash flow margin has maintained a healthy level as well. Their earnings yield has increased from 2009 until 2012, despite a moderately stable, low dividends yield. Again, although they maintain a relatively low dividends yield, and this dividends yield is not expected to increase superior or substantially into the future, we are wanting to capitalize on the growth that is within this industry. Per share metrics, as you can see, earnings per share has increased year over year. But more importantly, you can see that free cash flow per share has increased from 2010 until 2012, with a $3.18 free cash flow on a per share basis. Here I'm just showing you the composition of total invested capital and the changes year over year. As you can see, total invested capital is primarily comprised of net operating working capital, which will lead to decreased depreciation costs and more flexibility. Also note the substantial increase in invested capital in 2008. In 2008, with a substantial increase in invested capital, despite a positive NOPAT, they did experience negative free cash flow. However, they did recover in 2009 and then dipped slightly down in 2010. However, from 2010 until 2012, they have increased both NOPAT and free cash flow year over year, which is very positive given our valuation model is based off the generation of free cash flow. Moving on to ROA, ROE, and ROIC. As you can see, over the past 5 years, ROA and ROE have remained relatively stable with slight fluctuations. On the other hand, ROIC has fluctuated just a little bit more with an ROIC of at least 40% over the last 5 years. It has grown since 2010 to a limit of 76.3% for the most recent period. Here's just a comparison of annual returns with S&P, Qualcomm, and Intel. As you can see, Intel has had negative returns for the majority of the year, while Qualcomm has maintained positive returns, or has at least kept up with the S&P on a better basis than Intel. Moving on, here's this chart of Qualcomm versus the S&P, and as you can see, Qualcomm has lagged the S&P for the majority of the year. However, we do believe that Qualcomm is undervalued and will increase in stock price. Here's just a chart detailing the EVA versus the MVA. EVA has remained relatively stable from 2007 until 2010. From 2010 until 2012, it has increased, which is very positive to note. However, MVA has experienced a slight decrease in the most recent period, which shows that there could be some unpriced economic profit in Qualcomm. Moving on to the forecasts. We'll start with the balance sheet inputs. Looking at the cash and equivalents and inventory, I felt that the averages were representative of what happened over the past 5 years and what is expected to happen over the next 5 years. However, total receivables had a 37.6% in 2008, and therefore that was excluded from the average and recalculated to a 6.9%. Moving on, we felt that the averages ranging from total current assets all the way down to total current liabilities was representative. However, looking at total debt, Qualcomm has not utilized debt in 3 of the past 5 years. They utilized debt in 2010 and 2011 to make an acquisition of Atheros, and therefore, instead of using an average of 3.3%, we decided to taper that down to a 1.1%. Moving on to income statement forecast. We'll start with revenue growth. S&P, Argus, Credit Suisse, and Capital IQ all had forecasted revenue at about 27% to 33%. Therefore, to remain on the more conservative side, we tapered that down to 24%. Then year over year, we slightly decreased it into a moderate yet sustainable 3% long-term growth rate for revenue. Additionally, as you can see in their gross margin and their operating margin, it has remained relatively stable over the past 5 years, and therefore we felt these averages were adequate. Net margin, we adjusted at 30% to take out the outlier of 2009 of the 15.3%. So that 30% is the average from 2010 to 2012, which we felt was more adequate and representative. They just announced a recent shares buyback program of $5 billion, and therefore we decided to not use the 0.5% common shares growth rate and instead use a negative 0.5%, and that's the reasoning behind that. Furthermore, dividend growth over the past 5 years is 12.3%. It's up at 34.02%, as it was noted in their 10K in their 10Q that their annual dividend would be around 34%, with a recent 40% quarterly dividend increase. From 34%, we tapered the dividend growth rate year over year to a moderate yet sustainable 3% growth rate. Moving on to the weighted average cost of capital. We smoothed the beta down to a 1 at the market, and then transferred the revenue growth rate from the long term into the weighted average cost of capital at 3%. That gave us a WACC of 9%. Now, considering the fact that Qualcomm has generated ROIC year over year at or above 40%, this creates a huge value spread for Qualcomm, which further supports a buy thesis. Moving on to intrinsic value versus current price. As you can see in bold, that is the intrinsic value versus the current price in blue. The intrinsic value as of 2012 is $76.50 based on the present value of free cash flow, and it'll grow up until 2017 to $100.67. Again, this is based on conservative growth estimates, so this could be actually higher than what we are projecting. Looking at the dividend discount model, we transferred the growth rates from the income statement into the dividend discount model. In transferring those growth rates, we came up with an intrinsic value of $25.91 compared to the current stock price of $65.16. All this shows is that the current stock price is backed up by dividends alone about 40%, which is highly positive. Moving on, here's just a graphical depiction showing how Qualcomm is currently undervalued in the market right now based on the present value of free cash flow in our intrinsic valuation model. On the other hand, you see that it is overvalued compared to the dividend discount model. However, we see the fact that it is supported by dividends, or 40% of their current stock price is supported by dividends. So moving on to the summary and recommendation. First to note, Qualcomm's patented technology secures its position within a rapidly growing industry. The number of worldwide mobile connections is expected to increase to 8.3 billion in 2016 from 6.6 billion. Furthermore, despite a low dividend yield, the growth in the industry will provide for sizable capital appreciation, and we will continue to keep an adequate dividend yield from only slightly trimming the exposure in Intel and Microsoft. And again, as I just mentioned, they are currently undervalued based on the present value of the free cash flow model. And for these pieces of evidence, we recommend a buy position on Qualcomm. Are there any questions?
Any questions about Qualcomm? Great. I know you're all highly convinced.
A large portion of their earnings are from royalties. They have a dominant position in 3G, but a less dominant position in 4G. Why wouldn't you see a revenue growth decline due to that?
Are you talking about the income statement forecast, why we would be tapering that down?
Yes.
We would just taper that down year over year to get to that long-term sustainable growth rate that will act in perpetuity. Although we don't expect their revenues to decrease every year, we do need to get to a moderate sustainable growth rate, and that was that 3%. And therefore, instead of doing it drastically by increasing year over year over year, which is what we expect, we decided to taper it down to be more conservative and to maintain a 3% growth rate in the perpetuity.
Bree, I agree with your analysis. I think your concepts are really strong here. Just help me out with something though. Looking forward longer than say the next 2 or 3 years for Qualcomm, over the long run, they're going to have to start really attracting a lot of penetration into the emerging markets, into the areas now that really can't afford a $800 telephone or whatever it is, whatever those things cost. With that in mind, what happens to pricing in their markets? For example, historically, what has happened to Intel's pricing as they start to penetrate less profitable markets? Do you think that in general they're going to see margin squeeze of some kind starting in the next 2 or 3 years as they start moving downscale into the more emerging markets?
From what I've seen in my research, I noted that Qualcomm is I guess differentiating their product just a bit to make it more affordable for those emerging market countries. And they do recognize that they will have somewhat of a shrink in their margins. I guess my best answer is that from what I saw in my research, they will continue to differentiate their product to provide a more affordable smartphone, tablet, whatever it may be, to those consumers in the emerging markets. So they are going to try to offset some of those costs, I guess, with just a different technology base. And so the margins will shrink, but it shouldn't be by a sizable amount.
Other questions on that Qualcomm pitch?
I was just curious. We got no debt on the balance sheet at the end of 2012, but you're forecasting debt over the next few years. I just, as you said, they used debt in 2010, 2011 to acquire companies. So you're expecting them to acquire more companies, or you just think they'll, or I just wondered, maybe you saw something in the 10K that said they would do that or whatever.
Based on their 10K, management did note that they are interested in acquiring more affordable companies that will increase their core competencies and sustain them a competitive advantage. However, they did not note specific acquisitions in the future. Therefore, to remain conservative, instead of using a 0%, I bumped it up to a 1.
All right, thanks.
Other questions? If not, oh, Brady.
Thank you. Hi, Bree. Brady Rothrock, Sprint Nextel Corporation. Working in the mobile industry, we've been told a lot by our executives that tablets are the next big thing. Obviously, it's really growing, along with some other industries like vehicles, TVs, and things of that sort. You touched on cars, or sorry, not cars, you touched on smartphones. Do you know anything about Qualcomm's either already doing or expectations for the tablet industry, smart TVs, cars, and anything of that sort?
Yeah.
The plans?
In my research, I noted that their CDMA technologies, which is their primary technology, if you remember, it includes voice and graphics. And so that is interchangeable, whether it's a smartphone, a tablet, a television, or car. And I noted that they're actually going to be trying to get into the energy market, or just electric systems in that sense. So yeah, the growth that will associate itself with tablets and TVs and smart cars, Qualcomm will be able to take advantage of that because their chips will be able to be used in some of those technologies.
Yes. And another question.
This should be pretty quick. I did notice 2012 had an operating margin shrink of 4%. Did you read anything as to why that might have happened?
Honestly, I didn't. I just looked at the overall 5-year period and noticed that it had maintained itself relatively stable with slight fluctuations year over year. And so I did not delve into that too specifically, but that is a very good point.
Thanks.
All right, let's thank Bree for that pitch.